Usually, when you pull up a stock chart on your phone or, your trading desk, there is this underlying assumption of absolute transparency.
Right, yeah, like you're looking at the whole picture.
Exactly. You look at it like you're reading a thermometer, right? The price of a share is, say, $90. It's just right there on the screen.
Printed in stark red or glowing green.
Yeah, and it feels absolute. It feels clean. I mean, we are just wired to like things that are visible, categorized, and, definitive.
Oh, absolutely. But it gives this completely false sense of security. Because that number on the screen, that's just the agreed upon value at that exact millisecond in time.
Right.
It tells you absolutely nothing about the underlying forces that pushed it to that number, or honestly, the forces preparing to push it somewhere else.
And that is exactly the core illusion we are dismantling today. So welcome to today's deep dive. We're thrilled to have you with us.
It's great to be here.
Today, we're looking directly at you, the listener who is just, tired of getting faked out. You know the feeling. You buy a breakout and the price immediately plummets.
Oh, yeah, the classic trap.
Right. Or you panic sell a drop and then it immediately rockets to all-time highs. You're looking for a way to see the market not as this series of chaotic, random movements, but actually as a mechanical system.
Because it is a mechanical system.
Yeah, because when you step into the real currents of how massive institutional capital actually operates, that neat little price thermometer is essentially broken. At best, it's only telling you half the story.
When you are only looking at price action, you are essentially navigating completely blind. Because, price can be engineered.
Oh, heavily engineered.
Yeah, it can be temporarily suppressed or artificially inflated just to trap retail traders.
Yeah.
The price action you see on the surface is very often the very last thing to actually move.
Which brings us to our mission for today's deep dive. We have basically pulled apart some of the most highly regarded trading masterclasses and technical strategy guides available out there.
Yeah, some really dense material.
Very dense. And we're specifically focusing on the hidden footprints of institutional money. We are talking about on-balance volume, or OBV for short.
OBV, right.
Because while a candlestick on a chart can absolutely lie to your face, the underlying volume, like the actual physical number of shares changing hands, that rarely lies.
It's the plumbing of the market.
Exactly. Today we're going to explore how OBV acts like an X-ray machine for that plumbing, revealing the hidden buying and selling pressure before the price even twitches.
But before we get into the mechanics of that, it's vital to address the skepticism you might be feeling right now.
Oh, for sure.
If you're listening to this and rolling your eyes at the phrase technical indicator, just hold on to that skepticism. It is a literal survival trait in the trading world.
Yeah, you need it. There's a lot of garbage out there.
Endless amounts. There is an endless supply of snake oil out there.
Right.
People selling magic arrows that print on your chart and promise to make you a millionaire overnight.
Right.
Our goal today is entirely different from that. We are not handing you some mathematical formula and telling you to blindly follow a squiggly line.
We are absolutely not doing that. If you just want a cheat code, this really isn't the deep dive for you.
No. We need you to understand the underlying behavioral mechanics. Like, why does volume precede price? What are the actual logistical constraints of massive hedge funds that force them to leave these volumetric footprints?
Because they don't have a choice, right?
Exactly, they don't. Because once you understand the actual order flow reality of the market, you stop acting like retail liquidity.
You stop being the bait.
Right? You stop falling victim to the fear of missing out, that FOMO that forces you to buy the absolute top of a market cycle just so the smart money can sell their heavy bags to you.
So let's start by opening up the hood on this thing. I want to look at the engine of on-balance volume. Like, where did this actually come from? Because this isn't some beta test script written by a crypto trader on Discord last week.
Oh, far from it. No, this goes all the way back to 1963.
Wow, 1963.
Yeah. A legendary financial writer and market forecaster named Joseph Granville developed it. And the context of 1963 is actually crucial to understanding why it works so well.
Right, because the technology was totally different.
Completely different. Granville didn't have high-frequency algorithmic trading bots. Yeah. He didn't have a glowing multi-monitor setup with real-time tick-by-tick candlestick charts.
He probably had a lot of paper.
So much paper. He was looking at physical ticker tape and the daily closing quotes printed in the actual newspaper.
And even with that delayed, totally analog data, Granville recognized a physical law of the markets. Volume is the primary driver of everything.
Yep, the absolute engine.
So he built OBV as a momentum indicator. Its sole purpose is to measure the net flow of volume in and out of an asset over time. And he had this brilliant way of describing volume.
The spring analogy, right?
Yes. He called it a tightly wound spring. When the volume of an asset starts rising aggressively, but the price is just drifting sideways, doing nothing, that spring is winding up tighter and tighter.
The tension builds.
Exactly. And eventually the mechanical tension just has to release.
And what's fascinating here is the brilliance of what Granville built lies in its absolute binary simplicity. I mean, it is a cumulative indicator.
Meaning it just adds up over time.
Right. It keeps a running tally, a constant scoreboard based entirely on the closing price of the asset relative to the day before.
Okay, let's unpack this math, because as someone who stares at charts all day, I really need to know how the sausage is made here.
Sure, let's get into it.
And thankfully, you really don't need an advanced degree in quantitative finance for this. It's basically a 3-rule system based on today's close versus yesterday's close. Walk us through it.
Okay, so the rule set is entirely mechanical. Rule number 1, if today's closing price is even 1 single penny higher than yesterday's closing price, that is categorized as an up day.
Okay, up day, got it.
You take the entire trading volume for today, literally every single share that changed hands, and you add it to a running total.
So an up day means pure addition. What about a down day?
That's rule number 2. If today's closing price is lower than yesterday's, you take today's entire volume and you subtract it from your running total.
Okay, simple enough. And if it's a perfectly flat day, say if a stock closed at exactly $50 yesterday and then exactly $50 today.
Then rule number 3 kicks in, you do nothing, you add 0 to the running total. The OBV line just stays completely flat.
So it pauses.
Right. It is a continuous, unbroken ledger of buying pressure versus selling pressure.
I want to ground this in a visual reality for the listener, because I think hearing the math is one thing, but seeing it is another. Let's build a timeline using one of the examples from our source material. Let's look at a daily chart for Visa.
Oh, the Visa example is great for this.
Yeah. We're going to track it over 3 days to see how this line is actually drawn on the screen. So picture your chart. The top half is the price action, the standard candlesticks. The bottom half is a separate panel containing a single continuous line. That is your OBV.
Okay, so let's establish the baseline here. It's day 1. We check the OBV value on the chart, and the running total for Visa is sitting at $2.469 billion.
That sounds like a massive number. Billions of shares.
It is massive, yeah, but only because it's a cumulative total that has been running for a very, very long time. That's just our arbitrary starting point.
Okay, day 2. The market opens, the algorithms do their thing, human traders panic and rejoice, whatever, and the closing bell rings. It's a red candlestick day.
Okay, so a down day.
Right. Visa closed lower than day 1. We look at the total volume of shares traded for the day, and it comes in at 4.148 million.
Because it closed lower, rule number 2 kicks in immediately. We subtract.
So we take that massive baseline of 2.469 billion, and we subtract today's 4.148 million. Our new OBV running total drops to roughly 2.464 billion.
And on your screen, that single line in the bottom panel ticks downwards.
Yep. Now the market opens for day 3. Day 3 is a recovery day. A solid green candle prints on the chart. Visa closes higher than day 2. And the volume for this positive day comes in at 3.843 million shares. So we apply rule number 1, right? We add.
Exactly. You take yesterday's dropping total of 2.464 billion, add the 3.843 million, and the OBV line picks back up, sitting at 2.468 billion.
Okay, so that's the mechanical process.
It is, but this actually brings up one of the most misunderstood aspects of this entire indicator. That final number we just calculated, the 2.468 billion.
Yeah.
It is completely, utterly meaningless.
Wait, hold on. We just spent all this time tracking the exact math to get to that specific number, and you're telling me the number itself doesn't even matter.
In isolation, it has absolute 0 value. If you call a trading buddy right now and say, hey, I'm looking at Visa and the OBV's at 2.4 billion, is that bullish?
Yeah.
They won't have a clue what you're talking about.
Because they don't have the context.
Right. The raw numerical value is just an arbitrary sum. It depends entirely on how far back in time your specific charting software started keeping track of the data.
Oh, I see.
If your broker's data feed starts in, say, 2010, your OBV might be 2 billion. But if another trader's software starts pulling data from 2020, their OBV for the exact same stock on the exact same day might only be 50 million.
Oh, wow. Okay, so if the raw number is just this arbitrary software artifact, what am I actually supposed to be looking at on this bottom panel?
You are strictly analyzing the trajectory, the slope of the line.
The shape of it.
Exactly. You're looking at the topography of the indicator. Is it carving out a staircase moving up? Is it cascading downward, making lower valleys? Or is it just chopping sideways in a flat line?
So it's relative.
Entirely. The entire value of OBV lies in its directional movement relative to what the price is doing on the panel right above it.
I want to introduce an analogy here because I think it perfectly captures this dynamic, and I really want to carry this visual with us for the rest of the deep dive.
Let's hear it.
Let's compare the stock market or any specific asset like Visa or Bitcoin or whatever to a massive industrial water tank. The water level inside that tank represents the current price of the stock.
Okay, tracking with you.
When the water level rises, the price is going up. When the water level drops, the price is falling.
I like this. It grounds the abstraction.
Now, your average retail trader is standing outside the tank, just staring at the water level. They see a ripple, they see it rise an inch, they see it drop an inch, and they are desperately trying to guess what it will do next, based purely on the sloshing of the surface.
Which is impossible to predict accurately.
Right. But on-balance volume is not a camera pointing at the water level. OBV is a digital flow meter physically attached to the hidden subterranean pipes that feed into the bottom of the tank.
Ah, okay. That's a great way to put it.
It is measuring the raw mechanical volume of water moving through the system. It asks one simple question. Is the main industrial pump forcing millions of gallons of water into the tank today? Or is the main drain open, sucking millions of gallons out?
That perfectly illustrates the concept of Granville's tightly wound spring. Because if your OBV flow meter is telling you that massive, unprecedented volume is being pumped into the tank, but you look at the water level and it hasn't really risen yet,
Something is going to happen.
you know something has to give. Mechanically, physically, if the volume is entering the system, the water level, the price has to eventually rise to accommodate it. The pressure is building beneath the surface.
But playing devil's advocate here for a second. If I want to see the flow of the water, why do I need this cumulative math equation? Why can't I just look at those standard vertical volume bars that are turned on by default at the bottom of almost every stock chart in existence?
The ones everyone looks at.
Yeah. The tall green bar for a big up day, the tall red bar for a big down day. Doesn't that show me the exact same pressure?
What's fascinating here is that it seems like it should, but it doesn't.
Yeah.
And relying solely on those vertical bars is actually a huge cognitive trap.
Really? Why?
Because individual volume bars have absolutely no memory.
No memory. Okay, explain that.
A vertical volume bar only tells you the isolated story of a single 24-hour period. When the closing bell rings, that bar stops, and the next day starts completely over at zero.
It resets.
So you look at a chart, and you just see a forest of bars. You see a massive green bar today, a medium red bar yesterday, 3 tiny green bars before that, a huge red bar last week. Your human brain attempts to visually aggregate that data.
And we are terrible at that.
We are. You try to intuitively calculate over the last 3 months who is actually winning the war, the buyers or the sellers.
Yeah, running algebraic calculations on visual data over a 100-day period, we just see a noisy barcode of red and green and we get completely overwhelmed.
Precisely. We naturally focus on the most recent, tallest bar, and we just ignore the aggregate trend. On-balance volume does all that heavy cognitive lifting for you.
It builds the story.
It takes the noise of those isolated daily bars and strings them into a continuous, unbroken narrative. It creates a cumulative memory. It smooths out the chaotic daily chop into a single line that clearly states, look, ignore the day-to-day noise. Over the last 90 days, the net pressure in the pipes has been overwhelmingly positive.
So OBV remembers the history of the flow, so we don't have to guess. That makes perfect sense. But to really leverage this, we need to understand why this flow happens in the first place. Like, why does the water level stay flat while the pipes are pumping?
That is the real question.
This brings us to the core physics of the market, and really the absolute central thesis of Joseph Granville's work: volume precedes price.
Volume precedes price. It is the closest thing to a natural law in technical analysis. And to understand why it happens, you have to understand the participants in the market.
The big players.
Right. You have to understand the vast, almost incomprehensible logistical difference between how you, the listener, trade and how institutional smart money trades.
Let's define the players here. When we talk about smart money, we aren't talking about a really clever guy on Reddit.
Definitely not.
We are talking about sovereign wealth funds, massive pension funds, top-tier hedge funds, entities that manage hundreds of billions of dollars. And their sheer size creates a massive physical problem for them that a retail trader simply doesn't face.
Think about your own execution. If you decide you want to buy 100 shares of Apple today, You open your brokerage app, you tap Market Buy, and your order is filled in milliseconds.
And the market doesn't care.
The global market doesn't even register your existence. Your 100 shares are a microscopic drop in the ocean.
But let's say I'm a portfolio manager at a massive fund. My quantitative analysts have spent a month tearing apart the balance sheet of some mid-cap logistics company. They have determined it is wildly undervalued, and the investment committee authorizes me to take a position. But not 100 shares. They authorize me to acquire 5 million shares.
A huge position.
Right. If I just open up my institutional terminal and hit buy 5 million shares at market price, what actually happens to the order book?
It would be absolute chaos. The order book is basically just a list of people willing to sell at various prices. If you drop a 5 million share market order, you instantly consume every single sell order at the current price.
Just eat them all up.
Instantly. But you still need millions more shares to fill the order. So your algorithm automatically reaches up to the next highest price, and the next, aggressively sweeping the entire order book.
I would cause a violent vertical price spike. I'd send the stock to the moon in 30 seconds.
And in doing so, you would completely destroy your own trade.
Because I'm driving my own price up.
Exactly. The first 10,000 shares might fill at your target price, but by the time you are filling the final million shares, you are buying at an astronomically high price that you yourself created.
Wow.
You would ruin your average entry price. And worse, the moment your buying pressure stopped, the price would likely crash right back down, putting your fund massively in the red.
So the smart money is essentially trapped by its own size. They cannot trade like retail. They have to employ a completely different strategy. Our sources refer to this as stealth accumulation.
Stealth accumulation, yes.
How does a multi-billion-dollar fund invisibly buy 5 million shares? That sounds impossible.
They do it with algorithmic precision over weeks or even months. They use VWAP algorithms, volume-weighted average price algorithms that are designed to break that massive 5 million share order into thousands of tiny microscopic orders.
Oh, so they just drip feed it.
They sit on the bid. When retail traders get spooked by, say, a minor macroeconomic news headline and start selling, the institutional algorithm is right there, quietly absorbing the selling pressure, catching the shares like a net.
They are essentially providing a floor for the stock.
Yes, they buy the dips, but they immediately stop buying the moment the price starts to tick up, so they don't cause a rally. They want to accumulate their entire position without waking up the rest of the market.
Let's look at this through the eyes of a retail trader staring at a standard price chart during this stealth accumulation phase. What do they see?
They see absolute boredom. The price is locked in a tight, sideways range. It goes up $1, it goes down $1.
Stop then.
It looks like a dead asset. A retail trader looking at that chart thinks, this is dead money. There's no volatility, there's no momentum. I'm going to sell my position and go chase that AI tech stock that's up 20% today.
And this is exactly where the X-ray vision of on-balance volume comes in. Let's go back to our water tank. The retail trader is looking at the water level. The water is perfectly flat, totally stagnant. They get bored and walk away. But we are looking at the OBV flow meter attached to the pipes. What is the meter showing us during this exact same sideways period?
The meter is printing a beautiful, steady staircase moving upward. It is making higher highs and higher lows, completely diverging from the flat price action on the surface.
But how does the math actually create that staircase if the price is just moving sideways? Like mechanically, how does that happen?
Because the institutional algorithm is highly active on the days the stock naturally ticks upward, they are participating heavily, driving massive volume on green days.
Right.
But on the days the stock naturally drifts downward, the institution steps back. They let it drift on very light volume.
Ah, I see.
So when the OBV math is applied, it's adding massive chunks of volume on the up days and only subtracting tiny slivers of volume on the down days. The net result is a sharply rising OBV line.
It's screaming at you. The indicator is literally saying, look at the pipes. Massive institutional capital's flooding into this asset, even though they are artificially suppressing the water level. The spring is being wound to the breaking point.
And inevitably, the institution finishes their accumulation. They secure their 5 million shares.
And then they stop suppressing it.
They turn off their suppression algorithms. And then a catalyst arrives, an earnings beat, a product announcement, or just a natural shift in market sentiment.
The spring releases. The price violently breaks out of that boring sideways range and starts rocketing upward. And this is where the psychological tragedy of the retail trader plays out.
It's sad, really.
It is. The person who got bored and sold at the bottom suddenly sees the stock on the top gainers list. They feel that agonizing FOMO. They watch it go up 10%, then 20. It's all over social media.
It's not take it anymore.
Right. Finally, the pain of missing out is too great. The stock is at an all-time high, and the retail trader aggressively hits the buy button.
And who do you think is selling them those shares?
The institutional fund.
Exactly. The fund that quietly accumulated 5 million shares at the absolute bottom is now happily distributing those shares at a massive premium to the retail traders who are desperately chasing the green candles.
And if you are watching the OBV line at that euphoric top, the price might still be inching higher, driven by retail mania, but the OBV line will start to cascade downward.
Because the smart money is exiting.
They have opened the drain. They are aggressively pulling liquidity out of the tank, leaving retail holding the bag right before the inevitable crash.
Understanding this cycle highlights why trading requires such profound psychological patience. OBV is an exercise in delayed gratification.
You can't rush it.
You really can't. When you spot that stealth accumulation, when OBV is rising but price is flat, you have to have the discipline to take a position and sit on your hands. You are aligning yourself with institutional timeframes. You cannot demand immediate gratification because the breakout happens on their schedule, not yours.
All right, so that establishes the underlying philosophy. Stealth accumulation, tracking the footprints, aligning with the smart money. But let's transition from theory to actual mechanical execution. Let's look at the charts.
Let's do it.
How do we practically apply this to confirm trends? Because, as they say, a trend isn't a trend until it's confirmed. You don't want to get trapped in a fake out.
The most foundational meat and potatoes application of OBV is pure trend confirmation. It's a health check. If you are looking at a chart and the price is in a beautiful, undeniable uptrend, printing higher highs and higher lows on the daily chart, you want to look down at your OBV panel and see the exact same architecture.
The sources provided a phenomenal historical example of this using Tesla. During one of Tesla's massive macro rallies, the price action was parabolic.
Just a rocket ship.
But what gave professional traders the confidence to hold through the minor dips was the OBV line. It was rising in perfect, synchronized harmony with the price.
That synchronization is your psychological anchor. It proves that the upward price movement isn't just a low-volume retail short squeeze. It confirms that the rally is being fueled by genuine, sustained, institutional capital flow.
The big boys are actually buying.
Right. As long as OBV is making higher highs alongside the price, the trend is structurally sound. But the moment the price makes a new high and the OBV line flattens out or starts to dip, that is your early warning radar. The fuel is running out.
But let's look at something more actionable, something a bit more aggressive. Let's talk about trading a breakout. This is where traders make their money, but it's also where they experience the most terror.
Oh, absolutely terrifying.
I want to paint an audio picture of a chart from the masterclass materials. We are looking at a 4-hour time frame for Amazon.
The 4-hour chart is an excellent battleground. It filters out the erratic, hyperactive noise of the 1-minute or 5-minute charts, but it provides signals much faster than a slow-moving daily chart. It's the sweet spot for swing traders.
Okay, so visualize this Amazon 4-hour chart. The stock has been trapped in a grinding, painful downtrend. If you take your drawing tool and connect all the lower highs on the candlesticks, you draw a descending trend line. It's acting like a heavy ceiling pressing down on the price.
Every single time the price tries to rally and touches that descending line, institutional sellers step in and hammer it back down.
Exactly. But then, on a random Tuesday, a massive green candle pushes up and violently breaks through that descending trend line. The price has breached the ceiling.
A breakout.
Now, I know exactly what it feels like to sit at a desk and watch this happen. You are paralyzed. You're thinking, is this it? Is the bear market over? Or is this a bull trap? Is the market maker just popping the price above the line to trick me into buying before they dump it and send it to new lows?
It is the moment of maximum psychological friction. Making the call on a naked breakout is basically a coin flip.
So we deploy OBV, but we don't just glance at it. And this is a massive tactical shift for a lot of traders. You actually draw on the indicator itself.
This is a crucial advanced technique. Many traders treat the indicator panel as a read-only display. You shouldn't.
You can interact with it.
You can and should treat the OBV line exactly like a price chart. You can draw trend lines on the OBV data. You can map out horizontal support and resistance levels on the volume line.
Okay, let's say we draw a descending trend line on the OBV panel, matching the angle of the ceiling we drew on the price chart. And in this Amazon scenario, the revelation is stunning. Not only does the OBV line break its own descending ceiling, but it shatters it.
It explodes through it.
The line violently surges upward. The sheer volume driving the breakout is undeniably massive.
If we connect this to the bigger picture, professional traders know that markets rarely move in a straight line forever. The initial breakout is often chaotic.
Right, and this is where the real confirmation happens. The OBV surges, breaks its trend line, but then the momentum cools. The OBV line drops back down and physically touches the exact descending trend line it just broke out of.
The retest.
It approaches it from above. It retests the line. The old ceiling has functionally become the new floor. The OBV line bounces cleanly off that old trend line and resumes its march higher.
That retest is the holy grail of confirmation. Think about the market mechanics happening there. The initial breakout requires massive buying. The pullback, the retest, is the market asking, are the sellers going to take control again?
Testing the waters.
Exactly. When the OBE bounces off that line, it proves that the selling pressure has been completely absorbed. The volume flow is structurally bullish. When you have a price breakout, accompanied by an OBV breakout, validated by a successful OBV retest, the probability of a sustained uptrend is heavily stacked in your favor.
And the outcome for Amazon? It triggered a massive multi-week uptrend. Traders who waited for that OBV retest caught the entire macro move with defined risk.
Now you have a high probability confluence. You have a violent bullish price structure backed by a violent OBV trendline break. The narrative is cohesive. Stacking these technical realities, price action plus volume flow, is how you filter out the noise and find the trades actually worth risking capital on.
Okay, confirming a trend is incredibly useful. It keeps you safe. It helps you ride the wave. But let's be totally honest with each other.
Sure.
Confirming a trend that is already happening is kind of the easy part. The holy grail of trading, the place where life-altering returns are actually generated, is in predicting the end of a trend, catching the absolute bottom of a crash, or getting out at the exact peak of a bubble.
Which brings us to the concept of divergence. This is the absolute core of advanced momentum trading.
This is where the magic happens. Let's establish a rock-solid definition here. Divergence is exactly what it sounds like. It's what happens when the price chart and the OBV line violently disagree. They separate, they tell two completely contradictory stories.
It is the visual mathematical footprint of that stealth accumulation or stealth distribution we talked about earlier.
Let's use a visceral example. Imagine you were trading gold, or maybe a major forex pair. Let's go with a classic setup on the daily chart. The asset has been in a brutal multi-month downtrend. It is just bleeding out. Every week it makes a lower low. The moving averages are pointing straight into the ground.
A total bloodbath.
If you turn on CNBC, every analyst is talking about macroeconomic headwinds and how the asset is doomed. The sentiment is pure fear.
If you are a retail trader relying solely on price action, your psychology is deeply bearish. You are terrified to buy. In fact, you are probably looking for a place to short the market, betting that it will collapse even further.
But then you look down at your OBV panel, and what you see stops you cold. Because while the price is printing that terrifying new lower low, the OBV line isn't falling.
It's holding strong.
It has stopped going down. In fact, it is distinctly carving out a higher low.
The price is descending into the basement, but the volume flow meter is pointing up to the first floor. This is defined as a regular bullish divergence.
I'm looking at this and thinking, hold on, if the price is aggressively tanking and my portfolio is bleeding, why in the world would I trust a single squiggly line at the bottom of my screen telling me to buy? That feels like trying to get a falling knife.
It feels counterintuitive because you are fighting human nature, but you have to trust the mechanics of the order book. Think about what a bullish divergence actually represents physically.
Okay, break it down.
The price is dropping, meaning sellers are hitting the bid, but the OBV is rising. That means the sheer volume of shares being transacted on the minor upticks is vastly outweighing the volume of shares being dumped on the way down.
Oh, wow.
The sellers are throwing everything they have at the market, but an institutional buyer is sitting there, absorbing the impact like a giant sponge. The selling pressure is experiencing terminal fatigue. The smart money is loading the spring.
Let's apply this to a real-world scenario that destroyed a lot of retail portfolios. Our sources dug into a specific masterclass analyzing the exact signal that called the Bitcoin bottom during the depths of a recent bear market.
Ah, the crypto winter bottoms. There is no environment more emotionally taxing for a retail trader.
It was a total bloodbath. Bitcoin had crashed from its all-time highs. It consolidated for a while, gave people hope, and then the floor just gave out again. It plunged to a terrifying new lower low.
Panic everywhere.
The sentiment on crypto Twitter was apocalyptic. People were convinced Bitcoin was going to zero. Retail traders universally capitulated. They sold their bags at massive losses just to stop the pain. And by doing so, they completely missed the historic parabolic bull run that followed. Why? Because they only watched the red candlesticks.
They let the emotional weight of the price action blind them to the mechanical reality of the volume flow.
They completely ignored the massive, glaring, bullish divergence printing clearly on the daily OBV line. While Bitcoin's price plummeted to that final soul-crushing lower low, the OBV line firmly established a much higher low.
Well, whales were active.
Exactly. What was actually happening? The crypto whales, the institutional-sized players, were aggressively buying the panic. They were soaking up every single fraction of Bitcoin that terrified retail traders were panic selling. They built immense positions without moving the price up, and the moment retail ran out of coins to sell, the selling pressure evaporated and Bitcoin exploded upward.
That is the power of divergence. It allows you to mathematically anticipate the reversal of a trend rather than reactively chasing a trend after all the easy money has already been made.
Okay, here's where it gets really interesting. Let's operationalize this. If I'm a listener sitting at my desk right now, how do I actually trade this? Give me the step-by-step playbook for trading a divergence.
It requires strict discipline. Step 1. Identify the macro price trend. Is the asset clearly making higher highs, indicating an uptrend, or is it making lower lows in a downtrend? Let's assume it's a downtrend making lower lows.
Okay. Step 2. Look at your OBV panel. You are hunting for a structural disagreement. While the candlesticks are making a lower low, you need the OBV line to form a higher low. If it does, you have officially spotted a bullish divergence.
Step 3, and this is the step where impatient traders lose all their money. Plan your entry, but wait for secondary confirmation. Do not blindly buy the exact second you spot the divergence.
Wait, why not? If we just established that divergence is the holy grail, the literal footprint of the smart money, why wouldn't I smash the buy button immediately to get the best possible price?
Because OBV is a leading indicator. It is highly predictive, but its timing is imprecise. It tells you what should mathematically happen, not when it will happen.
Ah, the timing issue.
Right. An asset can flash a bullish divergence for weeks or even months before the smart money finishes accumulating and actually lets the price reverse. If you buy too early, you could endure weeks of grinding, sideways pain, or minor drawdowns. You might get emotionally shaken out or literally stopped out of your position right before the massive rally begins.
That is a perfect transition into the dark reality of trading, because we need to be very clear with our listeners here. OBV is an incredible tool, but it is not a magic crystal ball.
Far from it.
It is an instrument of probability. And probability, by definition, dictates that sometimes you will be wrong. We have to discuss risk management, fake outs, and the psychology of losing.
We have to talk about algorithmic liquidity hunting.
Let's dive into a specific brutal example from the forex markets, looking at the Australian dollar versus the US dollar, the AUD-USD pair. This is a masterclass in how market makers manipulate price to trap retail traders.
Picture a daily chart with a very clear, highly obvious horizontal support level. A floor. The price has come down, touched this line, and bounced off it perfectly 3 different times over the last year.
It looks so safe.
It is a textbook buy zone. Every retail trader with a charting app has a line drawn at this exact price.
So the price drifts back down to this magic support line for the 4th time. Retail traders lick their chops. They aggressively buy at support. And because they read a book on risk management, they place their stop-loss orders just a few pips beneath that support line, thinking they are safely protecting their capital. If it breaks support, I'll take a tiny loss and get out.
But you have to understand how institutional market makers view the board. They don't look at charts the way you do. They look at order book density.
They see the hidden layers.
They know exactly where those thousands of retail stop-loss orders are clustered. To a market maker, a cluster of stop-losses is just a massive pool of forced liquidity.
Explain that mechanism for a second. Why does the market maker care about my tiny stop-loss?
Because if a massive institution wants to buy a huge amount of the asset at a cheap price, they need someone to sell it to them. The easiest way to generate a massive wave of forced selling is to push the price down just far enough to trigger all those stop losses.
So what happens on the chart? The price approaches the support line, and instead of bouncing, it aggressively, violently spikes down through the floor. It breaks the support level.
It sweeps the liquidity. Thousands of retail stop losses are triggered, forcing them to sell their positions at a loss. The market makers gleefully buy up all those artificially cheap shares.
Now, if you are a disciplined trader watching this massacre happen, you are looking at your OBV, and you notice something incredible. While the price made that terrifying lower low, breaking support and stopping everyone out, the OBV line completely ignored it.
Ignored it entirely.
The OBV printed a massive bullish divergence, making a higher low.
The OBV is mechanically screaming, "This price drop is a lie. There is no genuine institutional selling pressure behind this breakdown. It is a fake out."
But if I'm an arrogant trader, I might see that divergence and instantly jump in, trying to catch the absolute bottom of the drop to maximize my profit. How does the professional handle it? Remember, step 3, wait for confirmation.
In a fake out scenario, confirmation has a very specific structure. You do not buy the dip. You wait for the price to recover and actually reclaim the support level it just broke. You wait for the daily candlestick to close firmly back above the floor.
That close above the line is the market proving that the breakdown was just a liquidity hunt. Once it reclaims support, then you enter your long trade. But here is the most important part of the entire deep dive. Where do you place your stop loss?
You place your protective stop loss just a few pips beneath the absolute bottom of the fake out wick that just occurred.
Right there.
Because it defines your mathematical invalidation point. If the price drops again and breaks below that new fake out low, it means your entire thesis was wrong. It wasn't a fake out, it's a genuine market collapse.
Oh, that makes sense.
By placing your stop there, you take a small, highly calculated loss and protect your account. But in this specific IUD-USD historical example, the reclaim worked flawlessly. The price rocketed higher off the reclaimed support, and the patient trader took massive profits at the previous macro highs.
That is how you use risk management to turn a market trap into a high probability setup. But I want to inject some harsh reality here. I want to talk about a trade where the trader did everything perfectly, followed all the rules, and still got their face ripped off.
This is a vital reality check. We have to look at the GBP-JPY losing trade example.
Okay, so in this example, a trader is analyzing a 1-hour chart for the British pound against the Japanese yen. They spot a beautiful textbook setup. The price comes down and taps a well-established support level. The candlesticks show clear rejection. Buyers are stepping in.
The OBV.
The OBV is printing a glaring, undeniable bullish divergence. Price made a lower low, OBV made a much higher low. The trader has support rejection, they have volumetric divergence, they wait for a bullish candle close, they check every box, they enter the trade and place their stop loss safely below the recent low. It's a perfect setup.
And what does the market do?
The market rolls over, casually breaks right through support, plummets, triggers their stop loss, and they lose the trade. Just like that.
So what went wrong? Was the indicator broken? Was the math wrong?
No. The indicator performed exactly as designed. The failure comes down to 2 things. First, time frame noise. They were trading on a 1-hour chart. Lower time frames are inherently noisy, chaotic, and subject to algorithmic spasms.
A lot of false signals there.
Right. A divergence on a 1-hour chart simply does not carry the mathematical weight or reliability of a divergence on a 4-hour or daily chart. The higher the time frame, the more millions of dollars are required to move the indicator, making the signal much more robust.
And the second reason it failed is simply the mathematical reality of trading. This is where the psychology of beginners just shatters. They find a strategy, they execute it perfectly, it loses, and they instantly assume the strategy is scam and throw it away.
A professional looks at that GBP-JPY loss and says, that is just the statistical cost of doing business. There is no holy grail. There is no strategy with a 100% win rate. Let's say a highly optimized OBV strategy wins 60% of the time. That means out of every 10 perfectly executed trades, you will do everything right and still lose money 4 times.
Which is exactly why the stop loss is an absolute non-negotiable requirement. In that losing trade, the trader was wrong, but because they used a stop loss, they only lost 1% of their total account equity.
They survive.
They preserved their capital to trade another day. If they had traded with ego, refusing to use a stop because the divergence was perfect, that single trade could have liquidated their entire account.
Emotional control is everything. You cannot let one statistical loss derail your discipline. And you cannot let boredom force you into overtrading garbage setups on a 5-minute chart just to feel the dopamine hit of being in a trade.
That brings us to fine-tuning the system
Mhm.
and fully acknowledging the structural limitations of on-balance volume. We've praised its elegance, but we have to expose its major mathematical flaw.
Right. There is a glaring vulnerability in the formula. What happens to our beautiful cumulative line during a massive anomalous volume spike?
It completely breaks the visual scale of the chart.
Let's visualize this. You're trading a solid tech stock. The OBV has been printing a readable stair-stepping pattern for 3 months. You have your trend lines drawn. It looks great. Then the company announces a surprise earnings beat that doubles Wall Street estimates. Or maybe the stock gets added to the S&P 500 index.
The opening bell rings the next morning, and the volume is absolutely astronomical. A massive wall of institutional money floods into the asset. You might see 50 times the normal daily average volume processed in a single trading session.
Because the OBV math just indiscriminately adds the entire day's volume if the price closes up, what does that actually do to our chart?
It prints a vertical line straight up into the stratosphere. Because that single day's volume is so disproportionately massive compared to the last 90 days, the chart software has to violently zoom out to fit the new data point on the screen.
And when it zooms out, all of your historical data, those months of careful, readable stair steps, gets visually squished down into what looks like a flat, meaningless pancake at the bottom of the screen. Your trend lines are useless. The historical context is totally destroyed.
The indicator becomes temporarily blinded by the flashbang of that single event. You either have to sit on your hands and wait weeks for new data to build a readable trend at the new scale, or you have to go into your software settings and manually exclude that specific date's data, which is a messy, imprecise hack.
So knowing this limitation, how do we mitigate the risks? How do we filter the signals? The answer is layering. You never, ever use OBV in total isolation. Because it's a leading indicator, it is prone to false starts. You need to anchor it with lagging indicators that confirm the reality of the move.
One of the most mechanically effective ways to do this involves a brilliant UI trick in your charting software. Instead of just trying to eyeball the OBV trend, you can actually apply a moving average directly to the indicator itself.
Oh, explain exactly how a listener does this, say, in standard software like TradingView, because we aren't talking about putting a moving average on the candlesticks up top, right?
Correct. You open your indicator panel, find the OBV settings, and you add a moving average like a 50-period exponential moving average, or EMA. But you set the source data for that average not to the stock's price, but to the OBV data feed.
Clever.
This draws a smoothed-out moving average line running directly through the peaks and valleys of your OBV line.
That is incredibly slick. What does that give me as a trader?
It removes all the subjective guesswork. You don't have to wonder if the OBV is in an uptrend. When the raw OBV line crosses above its own 50-period moving average, that is an objective, mechanical, bullish shift in momentum.
It's a clear signal.
Yes. When it crosses below, the volume trend has died. You can literally trade OBV breakouts relative to its own average.
Our masterclass sources also heavily emphasized pairing OBV with momentum oscillators, specifically the relative strength index, the RSI. How do those interact?
RSI measures the velocity of price movements to determine if an asset is overbought or oversold. It's an incredible filter. Let's say your OBV is showing a beautiful bullish divergence, hinting at a rally. But you glance at your RSI, and it's reading an 85, meaning the asset is massively overbought and mathematically overdue for a painful pullback.
That structural conflict is your signal to stay out. You want your indicators to harmonize, not fight each other. You wait for the RSI to cool off before taking the OBV signal. And of course, you pair all of this with the classic horizontal support and resistance levels we discussed.
You have to.
If OBV is surging, but the price is violently banging its head against a historic resistance ceiling that has held for 5 years, you don't buy the breakout until the ceiling actually shatters.
Before we wrap up the technicals, it's worth noting that while OBV is the grandfather of volume indicators, quantitative analysts have developed alternative metrics trying to smooth out OBV's blunter edges.
Right, because OBV's binary math is extremely rigid. If a stock closes up by one single penny, the entire volume for that day is added to the total. If the stock gaps up and closes $50 higher, the exact same volume is added. The formula does not care about the magnitude or severity of the price move. It only cares about the green or red direction.
Exactly. And that bluntness led to the creation of the accumulation distribution line, or the AD line. The AD line attempts to be more sophisticated by examining the intraday price action. It asks, where did the stock close relative to its absolute high and low for that specific day? If it opened low, rallied all day, and closed at the absolute peak, the AD line weights the volume heavily positive. But if it rallied, then gave up all its gains and closed near the bottom, the AD line drastically reduces the volume added, reflecting that the sellers won the day, even if the close was technically green.
And there is also the volume price trend, the VPT indicator. This one solves the magnitude problem by factoring in the actual percentage change of the price. So a massive, violent 10% up day will multiply the volume significantly, while a tiny, indecisive 0.1% up day will only add a microscopic sliver of volume to the total.
They are all different lenses trying to view the exact same puzzle, the footprints of institutional money. OBV remains the industry standard simply because its blunt binary math makes the divergences incredibly stark and easy to spot visually. But a complete trader understands the alternatives.
And this brings up a crucial point that connects directly back to you, the listener. You cannot just copy and paste a trading strategy from a deep dive or a YouTube video and expect it to automatically print money.
It does work like that.
You have to curate a system that matches your specific psychology, your risk tolerance, and most importantly, the specific assets you trade.
That is a vital distinction. The environment dictates the tool. If you are a trader who likes to gamble on micro-cap penny stocks or highly illiquid, obscure altcoins where the total daily trading volume is tiny, on-balance volume is going to be completely, utterly useless for you.
Why does it break down in those markets?
Because OBV fundamentally relies on the law of large numbers. It requires the massive continuous oceanic flow of institutional capital to create reliable, predictive trends. If you are trading a microcap stock where a single retail trader with a $50,000 account can cause a 10% price spike, the volume data isn't a footprint.
It's just random, chaotic noise.
Exactly. There is no smart money to track. OBV is an industrial tool designed for highly liquid markets, large-cap equities, major forex pairs, commodities like gold, and top-tier crypto assets with massive market caps. Match the tool to the environment.
So what does this all mean? We have covered an immense landscape today. We've gone from ticker tape in 1963 to the algorithmic slaughterhouses of modern forex fakeouts. Let's pull it all together. What is the ultimate takeaway here?
The takeaway is that if your entire analytical framework is based solely on the current price of an asset, you are voluntarily wearing a blindfold in a war zone.
Let's go back to the water tank. Let's go back to the engine analogy. The price is just the shiny paint on the chassis of the car. It looks great. It catches the eye. But on-balance volume is popping the hood.
You have to look under the hood.
It allows you to look past the paint and see if the pistons are actually firing, if the fuel lines are pressurized, or if the engine is completely hollowed out and about to stall on the highway. It shifts your trading from reacting to history to mechanically anticipating the future flow of capital.
But we promise to leave you with a provocative thought, something that pushes beyond the boundaries of the standard masterclass curriculum, a concept that questions the very nature of the footprints we are tracking.
Okay, lay it on us.
We've spent this entire deep dive operating on the premise that OBV exposes the hidden actions of institutional algorithms. But we must acknowledge the current reality. We live in an ecosystem completely dominated by artificial intelligence and high-frequency trading. These algorithms operate at the speed of light, executing complex game theory against human participants.
Right. They are apex predators.
So we have to ask the uncomfortable question. If retail traders are becoming more educated, if millions of retail traders are now pulling up TradingView, overlaying moving averages on their OBV panels, and actively hunting for bullish divergences, do you really think the multi-billion-dollar quantitative hedge funds don't know that?
Oh, man. They definitely know it.
Is it possible, perhaps even probable, that an institutional algorithm could deliberately execute rapid, strategically mathematically timed buy and sell orders that are precision engineered not to move the price, but specifically to manipulate the OBV calculation?
Wait, really?
Could a market maker intentionally paint a beautiful textbook bullish divergence on the OBV chart solely to trigger the buy signals of millions of retail momentum traders,
creating a massive surge of artificial retail demand,
which provides the exact exit liquidity the institution needs to quietly dump their massive losing position onto the retail crowd?
That is absolutely chilling. It turns the entire premise upside down. It forces you to look at your chart and ask, am I looking at a genuine footprint of institutional accumulation? Or am I looking at a highly sophisticated, digitally manufactured trap designed specifically for me?
The cat and mouse game never stops evolving. The market adapts to the tools used to measure it. This is why risk management is your only true defense, and critical thinking is your ultimate edge. Never blindly trust a single line on a screen.
That is something to deeply chew on for your next trading session. And we want to hear from you listening to this right now. Do you already use on-balance volume in your technical stack?
We'd love to know.
If so, how has it actually impacted your real-world execution? Have you caught a macro bottom using divergence? Have you been brutally faked out by algorithmic liquidity hunts? Or after listening to this deep dive, are you going to open up your charting software today, overlay that 50-period moving average on the OBV pane, and look at the market through this lens for the very first time?
It requires patience and it requires practice, but once you learn to read the volume, you can never look at a naked price chart the same way again.
Drop us a comment, send us a message on your platform of choice, and let us know how you are applying this system. Thank you so much for joining us on this incredibly detailed mechanical journey through the actual plumbing of market momentum. Keep learning, keep questioning your assumptions, and keep diving deep. Because the next time you look at that thermometer, the next time you see that clean, absolute red or green number on your screen, you know the truth. There is a massive, highly pressurized system hitting right beneath the surface. Stay curious, everyone.